And hello, my colleagues, and I hope everyone is well on this beautiful Thursday morning, nice and brisk, 26 degrees where I am. So we finished up on chapter 6, and what I want to basically cover is chapter 7 now. We priced bonds, now I want to price stocks, right? So hold on here. Let me, if you want to see me, I haven't seen you in a while. All right. So at some point, people want to know, well, what is the value of a stock share that I should buy? How is it priced? So here's a typical example of Tesla. All right. Here's Tesla. And they have a nice little blurb about Tesla. Now, I own Tesla, and this is somewhat old. So you can see the old stock prices, and I did very well with Tesla. I made several $1,000s on that stock. Okay. So I just want to say we'll be looking at now pricing in Chapter 7 stocks. All right. So what is the difference between bonds or debt and equity? And basically it could be just summarized in this table below. With debt, you have no voice in management, right? You just loan the money and you get it back. Equity, you may have voting rights, right? You could be voting. You could be a voter. So you may have voting rights. You have claims, basically claims on income and assets. You have senior claims, right? You're senior to common stockholders. So you'll get anything, assets that are sold first if the company goes belly up. And of course, if you're senior, then with equity, you're subordinate to debt. Maturity, it's as stated in the bond, right? 10 years, 20 years, 30 years. Equity is none. Tax treatment, you basically get an interest deduction. Basically, if from the corporation, you get an interest deduction on the basically debt, coupons you pay, but there's no interest deduction on the dividends. Okay. So this is from the standpoint of the holder, and the tax treatment is from the standpoint of the corporation, right? All right, so here's the some of the items here. So you have a voice in management through your voting privileges, right? And we see that here. They mention voting privileges. And here's your claims, right? Here's your claims on your on assets. So stockholders' claims on income and assets are secondary to the claims of creditors. All right. So stockholders' claims on assets are also secondary to the claims of creditors. Now, hold on. Is that a mistake? Well, let me look at that. Oh. So this should be, all right, well, one of these should say the debt holders, right? Oh, on assets, and this one is income and assets. All right. Well, it's kind of a little bit repetitive. All right. All right. So as you know, debt has a maturity. And technically, stock is a permanent form of financing. When you buy shares, right, you're a partial owner. However, companies do go belly up. The stock doesn't mature, but it does go the company will go belly up. So nothing's ever permanent in life, right? All right. So you see here, interest payments, and this is important, to debt holders are treated as tax-deductible expenses by the issuing firm. So this is with regard to the company, right? Whereas dividend payments to a firm stockholders are not tax-deductible. All right, so the important point here is that this tax deductibility of interest lowers the corporation's cost of debt. financing. All right, so just so everybody knows, there's two types of stock. There's common stock, and then there's basically preferred stock. So we'll start with common stock first, right? So let's go look right here. Common or preferred stock, all right? And common is lower in priority than preferred. Again, so it's bonds, preferred, and then common stock owners get paid last in case the company has issues, okay? So the true owners of a corporate business are the common stockholders, right? So that's important to know. That's real important. So they're known as the residual owners because they get paid last. So whatever's left, they'll get, right? So they have the highest risk. So they expect a higher return. They cannot lose any more than they have invested in the company, obviously, right? All they can do is the company can go belly up. So if you buy stock, there's two things you want to gain on, right? There is dividends and capital gains, okay? Now you may either you'll get one or the other or both, all right? Depending on how well the stock performs. With Tesla, I have capital gains. I don't believe I have a dividend on that. I own a lot of different stocks, so, all right? But like AT&T, I believe my dividend is about 7%. All right, so there's different forms of ownership with stock, right? So most likely your stock is publicly owned. The common stock of a firm is owned by public investors, and that's what most of us all know, right? All know. So it's public, right? All right, so common stock has a par value that's assigned to it. It really has no meaning. You can see the magic words here. It's an arbitrary value established for legal purposes. That's it. In the firm's corporate charter, and it's usually set at $1. All right? Recall that when a firm sells new shares of common stock, the firm records the par value of the shares, and you'll see that on the income statement. I'm sorry, on the balance sheet. It's in the capital section of the balance sheet. All right, so they let you know what the par value was. So if you set a low par value, it's advantageous when certain states have corporate taxes that are based on the par value of the stock. So this is it. You have to do some research on which states worry about this. All right, so there's basically owning the shares gives you a preemptive right. And what is a preemptive right? It allows common stockholders to maintain their proportionate ownership in the corporation when new shares are issued. It protects them from dilution of ownership. And we'll read more about that. So a dilution is when a reduction in each previous shareholder's fractional ownership results from the sale of new common shares. All right, so a rights offering is another important term. And let's highlight that because that's important. Rights are financial instruments that allow stockholders to purchase additional shares at a price below the market price in direct proportion to the fractional ownership. So what they'll do is they may let you buy shares at a reduced price. All right, so this is important. All right. And they'll tell you that if they're issuing new shares. All right. So there's 3 terms here that are important: authorized, outstanding, and issued. All right. And these are pretty important. So the best way to look at these is to go over this example. So you'll notice here in example 1 here, the company has authorized the sale of 35 million shares, right? They are allowed to sell 35 million, but only 15 million were issued out of the 35 million, okay? So let's make sure we understand that. Okay. Now, what is treasury shares? You'll notice here they talk about treasury stock. They talk about treasury stock. And if you look here, when shares are issued or sold to investors, right? So if the firm repurchases any of its outstanding shares, they are recorded as treasury stock. And as you know, companies do buy back their shares, right? It happens a lot. So here's the cost of the treasury stock, which they basically bought back 1 million shares, right? They bought back 1 million shares. All right. All right. So I'm about 12 minutes into this now. So we'll pick up here. We'll pick up on voting rights for the next video. Okay. All right. Everybody have a good day and stay well.